All right. Good morning, everybody. It's Sunday morning. If you haven't had your coffee yet, go ahead and grab it. And it's good to see everybody here. It's by the way, who had the music choice for this morning? Little Billy Joel to start a Sunday morning. Anybody know who picked that one? So well, I don't know. It's not clear, but we have just to remind everybody, whoever is in the lead for that particular week gets to pick the pregame music, so to speak. So stay tuned on that. Anyway, good to see everybody. We are going to, or go back to the previous slide, if you would, Rich. This morning, we're going to talk about funding. And the funding is obviously a very critically important part of everything that we do here in financing our businesses. We are super happy and super blessed to have a CPA, Michael Reeder, on April 6th. That date is not inconsequential to accountants, folks. The fact that he was able to carve out an hour and a half of his time this morning to spend with us and talk about financing your franchise is pretty exceptional. And he is very committed. He's a longtime partner of ours. He heads up the Reeder Group. And we are going to have him talk with us about not just funding options, but it's not an inconsequential decision. It's the impact that that's going to have on our taxes. It's the impact that that's going to have on the formation of our entity, whether that's an LLC or whether that's a C corporation. Certain types of funding will force you into a certain type of entity formation. So there's a lot of things that are intertwined within that. Your coaches are very familiar and very well-versed to talk about all of that stuff as they will, custom to you. But we've got a CPA that can really dive deep into that stuff. So happy to see that. So we're going to go, that's going to be the meat of what we're going to talk about today. Michael's going to talk through, again, those financing options. What is the entity that is ideal for you? And then some of the tax strategy stuff. He's also going to go into the unit economics. Now, we covered that last week, if you remember, but he'll cover that a little bit more in depth. And then, as usual, we're going to save as much time as possible till the very end when we can get into our breakout groups. Each coach, Brittany and Doug, will take you guys into those breakout groups, and you'll be able to ask more intimate questions and have more, sort of custom conversations around what might be specific to you and things that you're seeing up until this point. Okay, cool. Next slide. Now, as always, interactive. Feel free to put any questions that you guys have in the chat, or just come off of mute and feel free to ask those questions as well. We will have predetermined times when we take questions at the end, and then obviously in your coach breakout sessions. But this is where we've been. Big journey, long journey. Purpose of that journey is to get you all to a decision point, whether or not franchising is right for you. And then secondly, if we found the right franchise, or if that is true and you're well suited for it, have we found the business that you're most well matched for? And as you've seen, because we're beyond that step now, many, many factors play into that. It's a combination of science and experience. And you've had now the opportunity to have a lot of those initial calls. So really good stuff. I would tell you, we are in the thick of the due diligence phase, right? That's that second phase. If we take those 10 steps, break those down into 3 phases. That first one is very internal, getting to know ourselves, coaches getting to know us, matching up with 12 to 15 concepts that we think might be well suited for. And then step 5 is when we start to go external and start to do that due diligence. Most of you have had franchisor calls by now and are considering the funding calls and how to fund your business. Next will come the validation stage, as well as when you get your FDD and looking that over. Some of you have already hit that stage. And then that final phase is it's time to decide, right? We've gone through all the internal stuff. We've gone through all the external due diligence. I would argue that, guys, there's probably never going to be a time in your lives when you've been immersed so much with so much relevant and trustworthy information at the appropriate time, as you will be in steps 9 and 10, to make an informed decision on whether or not it's the right decision for you to move forward with franchising and which one. So a lot of folks start to get fear at that stage, which is very, very natural. You're human. I would have to take your pulse if you did not have any. But as we talked about before, vetrepreneurs don't make emotional decisions. They make informed decisions. And that's what we're trying to get you to, is to make an informed decision. So, think about what that looks like. Visualize owning your business. It's very helpful to take a look at when you're talking with the franchisor, the development folks, when you get into validation and talking with other franchise owners. Visualize yourself running that business. And do you envision that? Are you going to be excited waking up every day doing what you're doing? It's not going to be a Disney ride. It's not going to be a fairy tale every day, but it's going to have ups and downs like anything. But it's going to be something that you control. And does that feel right to you? So that's really what we're in now, to finally get to that decision point phase, which isn't far away. We started this journey path together about 5-6 weeks ago, right? And we've got about 4 weeks until most of you will be 3 to 4 weeks until most of you will be going to that confirmation day or that discovery day and making those decisions. And then we purposely put graduation a little bit further out, 2 weeks out or 3 weeks out, so that we can give some people that might be a little bit behind in the 10-week process opportunity to become franchisors and to be recognized as franchisees, and to be recognized as a vetrepreneur when we have graduation. So we push that out a little bit, and that'll be right before Memorial Day weekend. Okay. And I just want to put the note out there. I think everybody's aware, but we did reschedule the FDD and validation call because of the holidays. So that's going to be on April 15th now. That was previously, I believe, on Palm Sunday. Okay, next slide, please. And this is where we are. This is our leaderboard, 2503, 25 strong. We've got several folks who are ahead, up in step 7, having already received their FDD. And we're going to go over that next week with all the different options that you've got in terms of that review, along with validation. Many of you, the heart of the class, the meat of the class is really right there where they should be in step 6, which is looking at financing your business. And then some of you are a little far behind, but not too far that you can't catch up in presentation of options and in franchisor calls. So congratulations to everybody there. That is our current status. Okay, with the next slide, I will introduce Michael Reeder, a native of Chicago, has his business running out of there, and he's going to tell us all about it. Michael, thank you so much. Take it away.
Thank you, Chris. Great to be with you all. Happy Sunday. So my name is Michael Reeder. I'm a CPA. I'm the owner of Reeder CPA Group. We're a virtual national CPA firm. We have locations in the Chicago area and also the Portland, Maine area. I've been living in Maine for the last 3 years, even though I'll always be a Chicago loyalist. There's my Chicago Bulls coffee cup. 38 years old. I've been a CPA in public practice for about 14 plus years. I own the firm that hired me out of college. And over the last 10 plus years, I've developed a niche as a CPA working with franchisee businesses by building up a nationwide network of franchise coaches, such as the Vetrepreneur team, to be a CPA resource for franchise buying candidates, such as all of you, to, while you're going through this franchise investigation and investment process, to be a CPA resource to answer any questions that you have in the context of entity structure strategy, funding strategy, tax strategy for small business ownership. Talking about FDD, item 19, and item 21 at a high level, also financial statement pro formas. But I have a large proof of work having these types of free CPA consultation calls over the last 11 years. And the things that are talked about the most are exactly the things that we're going to go through in today's, presentation, which are the things that you see right up there on the slide, right? Financing your franchise, financing, funding. So financing and entity structure strategy, and just diving into those two topics and coming at them from the angle of strategic tax planning. That's just what, regardless of, obviously it's tax season right now. So in my business, it's crazy because we're, approaching April 15th, but tax season or not tax season, what I am doing 12 months out of the year is having these free CPA consultation calls with prospective franchise buyers, such as all of you. And to be able to do so with the veteran community is such an honor for me. So thank you all for your service, and whatever I can do to help all of you reduce risk in business ownership and increase the chance of being successful. In business, it's my calling. It's my mission in business to be able to help business owners, especially veterans, succeed in business. And so it's very important to me to give all of you the best advice as possible. And so let's dive into those 6 things there. Edgar, if you don't mind going back real quick. Thank you. So what we'll dive into is, SBA loan, HELOC, 401k, TSP loan, ROBS, cash, family or friends, loan or equity. And another one to add there are securities-backed lines of credit. So if you have any non-retirement investment accounts, depending on the size of the portfolio, the financial institution, Schwab, Merrill Lynch, wherever it's sitting, that they might give you a line of credit just collateralizing the portfolio up to approximately 50% of it. So these are things that we dive into. And so in order for me to, as a CPA that's really knowledgeable about this stuff, in order for me to say, hey, Patrick Milligan, I think that you should go LLC with an SBA loan, and here's why. Or, hey, Susan Beatty, I think that you should go Rob C Corp, and here's why. Before I can tell you, before I advise you which one I think, of these, following options on the slide, before I tell you which one that you should go with and why, I always get context on 3 buckets, right? And so the Vetrepreneur team is, here he goes again with the 3 buckets, right? It's number 1, what's your investment level? Initial plus the first 12 months. To the best of your ability for the first 12 months, because a lot of times the FDD just gives you like initial plus the first 3 months, but initial plus the first 12 months, what's that total investment going to be all in, right? Initial franchise fees, working capital, fixed assets and build out if it's going to be a retail build out, right? Bucket 1, investment level. And then bucket 2, what's the allocation of assets on your personal financial statement, right? I'm looking for cash, other liquidity, retirement, and real estate. Right? That's bucket 2, the assets on the personal financial statement. And then bucket 3, what's your household income situation looking like? What W-2 income is coming into the household, what VA disability benefits, what taxable military pension, are you married? Does your spouse work? How much is your spouse bringing in? Do you have rental income, et cetera, et cetera? Bucket 3, household income. Once I have those 3 buckets on a piece of paper, right, investment level, assets, and income, then that helps me as a CPA drive the conversation, for funding and entity structure, coming at it from the angle of strategic tax planning, based off of those 3 buckets and how they're all attached at the hip. Like I said, I may advise to go SBA with an LLC for person A, or S Corp with securities backed line of credit for person B, or ROBS for person C, et cetera, et cetera. So that's just a high level of how I approach the funding and entity structure conversation. And I can't have anyone that purports to be able to advise you on entity structure and funding without knowing those 3 buckets. They don't have all the facts that are necessary in order to have an optimal conversation when it comes to optimal entity structure and funding conversation. So, Edgar, thanks for going back for me. If you don't mind, please. Now we're good. Thank you, sir. So choosing the right entity and formation. So entity types, right? LLC, S Corp, C Corp. Now, the biggest thing, like when it comes to entity structure, the two that are stacked up against each other, and it's like, well, do we go this one or do we go that one? Tends to be LLC and C Corp. Now let's unpack that a little bit. LLC is a legal structure. So an LLC with one owner by default. So if that one owner is an individual, that LLC by default is taxed as a sole proprietorship. An LLC with two or more owners by default is taxed as a partnership. At any time, either at creation, right, when the LLC is first set up, or subsequently, either later on that year or sometime in the next year or the next year, at any time, that LLC can elect to be taxed as an S corporation or a C corporation. Very rarely, for the LLC to be taxed as a C corporation, is that the strategy that we go with for small business owners. It could be the strategy depending on what you're doing, but more often than not, an LLC by default, we're going to have it start out be taxed as a sole proprietorship or a partnership, depending on how many owners there are. And then once there's enough profit to justify, we're going to elect it to be taxed as an S corporation, and we primarily do that to save money in Social Security and Medicare taxes. So that's an LLC is a legal structure, and it's a hybrid entity for tax purposes because it has its default tax classification, right, depending on how many owners, and then it has the ability to elect S corp tax treatment once there's profits to save money in Social Security and Medicare taxes. So that's LLC on one side of the ledger, right? The other side of the ledger that you see there at the bottom of the entity types is the third one, C Corp. And we're primarily going to come across C Corporation in this world of small business ownership when your entity structure, when your funding option is going to be the ROBS C Corp, right? So ROBS is an acronym for rollover as business startup, and it is a way for you to use it's one way. It's not the only way, but it's one common way, and it has its certain benefits. It's one common way to use your retirement assets to invest and operate your business, and it requires you to set up a C corporation, and the majority, if not 100% shareholder of the C corporation is going to be the retirement plan for the C corporation. And then the retirement plan for the C corporation is going to invest in the stock of the C corporation. So that's how the money finds its way from like your old IRA or TSP or 401k into the C corp checking account where it's used for the operation of the business, because the actual shareholder of the C Corp itself is the retirement plan. So it has some nuances. And as a CPA, myself and my team were very knowledgeable about the ROB C Corporation, both its pros and cons. And we obviously dive into all of that as part of the whole entity structure and funding strategy conversation, with each and every one of you. So when it comes to entity types, those, it's mainly going to come down to LLC versus C Corp and unpacking, the stuff that I just talked about. We talk about more as well, but like those are the predominant, after doing this for 11 years and having these conversations with so many business buyers over that time period, LLC versus C Corp, S Corp, LLC has the ability to be taxed as an S Corp, et cetera, et cetera. We rabbit hole into all that stuff for each and every one of you. And then formation steps, whichever one you go with, LLC, S Corp, C Corp, et cetera, you're going to start out with the state's Secretary of State, right? And with the Secretary of State, you're going to file an Articles of Organization if it's an LLC, or you're going to file an Articles of Incorporation if it's a corporation. And then once you file the necessary articles with your respective state's Secretary of State office, then you're going to get an EIN number, right? An employer identification number with the IRS for your entity. And then once you have, right, the articles with the Secretary of State and the tax ID number, also known as the employer identification number with the IRS, then you would register your entity with the applicable local and state taxing authorities, applying for any necessary payroll tax accounts, state income tax accounts, state sales tax accounts, any state or local licenses that you need. You would set all of those up, and you would do all of that regardless if you're structured as an LLC, S Corp, or C Corp.
Hey, Michael, if we could just take a quick pause. Does anybody have any questions so far? Yep, Susan, go ahead. Ask away. Come off mic if you would. Yeah.
Okay. Awesome. Thank you. I actually look at business tax returns every day for my job, so I've got lots of questions. Well, actually, just a couple. First of all, the ROBs that you were talking about, that financing option, how is that taxed since it's a retirement account? Is there a tax penalty for that?
It's a great question, Susan. So it's a C corporation. So if you don't mind me asking, Susan, what line of work are you in? Are you in like mortgage lending or something, or?
Yes, banking, financing.
Yeah, so I would imagine, you definitely look at a bunch of tax returns each day. So it's a C corporation, so it's a Form 1120, and the reason why it's a C corporation is because the majority shareholder, a lot of the times the 100% shareholder, is the retirement plan of the C corp itself. So it's a Form 1120. Just like any other 1120, it has its certain nuances in terms of related parties, like intercompany transactions that are prohibited transactions that otherwise would not be prohibited transactions if it was just a regular C corporation owned by an individual, for example. And so it's taxed as a C corporation. If Susan Beatty does a ROBS, then what happens is you would set up. And what state are you in, Susan?
Oklahoma.
Okay, so you would set up like how it would work is you would work with one of the ROBS companies to set up a Oklahoma C corporation. That would be step one, and then articles of incorporation with the Oklahoma Secretary of State, get a tax ID number, etc. And then so step one, you would set up an Oklahoma C corporation, and then step two is the Oklahoma C corporation would then get its own retirement plan, 401k profit sharing plan. And it would be an ERISA plan, right? Not an IRA. It would be an actual employer retirement plan under the ERISA rules, right? So now you have a retirement plan, a 401k profit sharing plan for the C corporation. That's step two. So now you have a C corp set up and you have a retirement plan for the C corp set up. Now you have, $250,000 sitting in an old TSP or an old IRA or an old 401k. And you want to use that $250,000, for either the entire investment or for a portion of the investment. You're going to use, and so what you would do is step one of the money flow is you would roll that money from like the old IRA into the new C Corp's retirement plan. So that step one of the money flow right there, that's a tax-free rollover because it's just a qualified rollover from, old pre-tax retirement plan into new pre-tax retirement plan. Does that make sense so far?
It does, yes.
Okay, cool. And then step two of the money flow would be the capitalization of the C Corp business, right? So now that $250,000 is sitting in the C Corp's retirement plan. And now the C Corp's retirement plan is going to invest in the stock of the C corporation itself.
Okay.
Right. So now it's going to go from the C Corp retirement plan into the C Corp checking account in exchange for stock of the C corporation. So now you get that. So that's the capitalization. So step one is the rollover, tax and penalty free rollover. And then step two is the capitalization of the business. Right. And that's how the money finds its way from the C Corp retirement plan into the C Corp checking account, where it can be used for the investment and the operations of the business. And so you can reimburse yourself. So for any, at that point, it's really common for while the Rob C Corp is getting set up, there are certain, there are business expenses that are being paid out of pocket because the C Corp hasn't been capitalized yet. So, during that time, the business owner is paying for business expenses out of personal funds. So once you get the C corporation capitalized, then you can reimburse yourself for any business expenses paid from personal funds. You can have the C Corp, reimburse you personally. But other than that, then if you want to take money out personally, then from the Rob C Corp, then you have to do so by as salary. So you would take a salary right from the C Corp to you personally. So the salary on the C Corp would be an expense. It would be a business expense, reducing the amount of income. It would be reducing taxable income in the C Corp, and you would pick it up as W-2 income. And it's a C corporation. So any startup losses, they don't flow through to the personal return like they do if it's a pass-through entity like an LLC, S Corp, partnership, etc. They stay in the C Corp and roll forward as net operating loss carry forwards to offset subsequent year C Corp taxable income. And then if there is any bottom line profit, and then obviously this is stuff that we tax plan about every year with our C Corp clients, it would be subject to C Corp income tax. There is a double taxation there that you have to be careful with because it's a C corporation. And so, it's a C Corp, so normal C Corp tax rates apply. And then there are certain rules. For example, like if it's just a C Corp owned by Susan the individual and it's not a Rob's, and if you wanted to loan yourself money, or if you wanted to 1099 a company like an S Corp that you have on the side from the C Corp, you could do that no problem with a regular C corporation owned by you. But a Rob C corporation, you can't, you can't take money out as a loan, like a loan that the C Corp is loaning you, Susan the individual. And you also can't, if you have another like side management, consulting S Corp, you can't 1099 the C Corp. You can't have this, you can't get money out of the C Corp by 1099 the S Corp because of both of those examples. Those are prohibited transactions, not because of anything like Form 1120 C Corp, but because it's a Rob's, those go against ERISA laws. And so like they would be viewed as, prohibited transactions, tax shelter, et cetera, because, the shareholder of the C Corp is the retirement plan of the C Corp. So I know I'm getting into the weeds a little bit, but that's kind of how, the navigation of compliance, is approached when you're a Rob C corporation.
Okay, that's great. Is there a dollar limit on that type of transaction or that type of loan?
Like for that type of rollover?
Mm-hmm.
No dollar limit.
And does it have to be a 401? Can it be a 401k that's is existing, that's still active, that's currently gaining money, or is it one that has to be from from a previous employer or something like that?
Great question. So it needs to be the old retirement asset. It needs to be a retirement asset that's eligible for rollover. So to your point, like if it's an existing 401k plan, chances are you're not like at your current job, like the 401k plan at your current job, most likely it's not going to be eligible for rollover. An example of where it could be, like where a portion of that could be eligible for rollover is if you're at your current job and you have a 401k, but your current job, it got like your current employer is the acquire, like they acquired, your previous employer. So you still work for the same company in essence, but it's like, it got acquired by private equity. So now you work for like the company that private equity, formed in the acquisition. Then then whatever your 401k was pre-merger, that amount would be eligible for rollover, but anything that you start contributing to like the new company would not be. But like that's an exception to the rule. The general rule is your current employer 401k plan is not eligible for rollover. It would need to be a retirement asset that's eligible for rollover, such as an old 401k, old TSP, or IRA, pre-tax IRA. You cannot roll over a Roth retirement asset into a Rob's. The only thing that you can do with Roth assets in a Rob's, the only vendor that has this option is Vetrepreneur. It's called they call it the Rainmaker Advantage Plan. Essentially, what you do is you can take out of the four Rob's the four major Rob's players in the game, right? Vetrepreneur, Fran Fund, Tenant, Guidant. Vetrepreneur offers one where you can do a rollover of a pre-tax retirement asset, and then once it's in the Rob C Corp's retirement plan, you can do an in-plan Roth conversion, and you could, thus, convert some of your Rob's ownership from pre-tax to Roth and then that's a taxable event. But then you can have your Roth retirement asset own a portion of the C Corp stock, but it has to first be pre-tax. You roll it over pre-tax, and then you can convert to Roth. You can't have like a Roth IRA that you have sitting over here and roll that into a Roth. You can't do that.
Okay. All right. And one last question, and this is about LLCs, because I already have an LLC set up. That's just my husband and I are the owners or the members. Now, is that considered sole prop, or is that considered partnership, since it's just a husband and wife? I thought they could still be like a sole prop.
Yeah. So a husband and wife partner, a husband-wife multi-member LLC can still be viewed as a sole prop.
Okay. Perfect. That's my last question. Thank you.
Yeah, you have the option. Like, you can have it be taxed as a sole prop or a partnership.
Okay.
Yeah, good stuff. And listen, a lot of people probably are not able to follow along in all of that. As I've said, Michael is the Ken Jennings of Jeopardy. The good news is you don't have to be the Ken Jennings of Jeopardy accounting. You just need to have access to someone like that, which you do. And as part of this process, you will have access to Michael or a member of his team for about an hour to talk through all of this stuff, very, very customized for you. I'll also say, if you canvass 100 business owners, very few of them would be able to even go remotely toe-to-toe with the kind of conversation that you just heard right there. So it's important to know kind of how it might affect you when you're setting these types of things up. But your job as a business owner is to represent the company and be the face of the company, to manage your resources and to lead your employees. It's not to be an accounting expert. So good to know this stuff, but not important as a business owner. Just good to have people like Michael and his team and others that are doing all of that work for you. And I'll talk a little bit about why it's important to outsource that. Mark, I know you had your hand raised. You want to come off mic and ask your question?
Yes, thank Chris. Good morning, Michael. The question I have, as far as setting up the entity, would we be doing that in the state of the business, or would it be the state of residence, or does it even matter?
Great question. So it normally would be, now there's always exceptions to the rule, but in the event that, for example, you're a North Carolina resident, but you're purchasing a franchise that's in the South Carolina territory, normally you would want the entity to be registered in the state where the business is going to be operating. So in that the general rule in that hypothetical right there was that you would set up a South Carolina LLC, because that's where the business is going to be operating, and it would be a South Carolina LLC owned by a North Carolina resident. And so you could. There's always exceptions to the rule, and then there's always, the question during entity that comes up during entity formation that comes up of, hey, should I structure as like a Wyoming holding company and then have have a subsidiary, operating in the state of where I'm actually going to be doing business, and then Wyoming, Delaware, Nevada always come up as like the common, I'm going to register in this state for certain reasons that are more like asset protection, anonymity reasoning, and stuff like that. Sometimes it makes sense. Sometimes it's a little overkill, depending on the situation. But no matter what, the entity needs to be registered in the state where it's doing business. So whether you actually domicile it there, right? Like the territory is in South Carolina, and you live in North Carolina in that hypothetical, you don't necessarily need, you could set up a North Carolina LLC, and it's, because you're a North Carolina resident, and you can have it then register as a foreign LLC in South Carolina because it's actually going to be doing business in South Carolina. And then, in that hypothetical, you would allocate all of the sales to South Carolina because that's where it's physically occurring, or you can just domicile it in the state where it's operating. So when I say domicile, that means like the home state, right? Like that LLC or that corporation is native to a certain state. And then if it's also doing business in another state, then it has to register as a foreign entity there. Or you can just create it as a domicile in the state where it's doing business. So wherever it's doing business, it has to be registered, whether that's a domicile entity or a foreign entity. Does that make sense? I know it's kind of in the weeds a little bit.
Yeah, that does. Thanks, Michael.
Yeah, you bet, Mark.
Okay, Michael, I think that's all the questions for now. So back to you.
Alrighty. Well, we're good with this slide, Edgar, if you want to go to the next one. Alrighty. So crafting a winning tax strategy. So key deductions for franchisees. So let's just unpack these a little bit. Terminology matters. In the world of accounting and tax, terminology matters. So a big thing to understand the difference between our initial franchise fees and royalties, right? Initial franchise fee is the initial franchise fee that you pay to the franchisor once you acquire the franchise. And normally it's, depending on how many territories you get, net of military discount, one territory usually hovers around 40. I know that there's some ZORs out there that have lower franchise fees, some that have, very small ones, but net of military discount, it's the thing that you're most likely going to pay like, 40 or 50K upfront. It could be like 90 to 130, depending on how many territories you get. That's an initial franchise fee. That's what you're paying for the right to use the, to pretty much operate that brand's name, trademark, et cetera, like in your territory. So those initial franchise fees, those are what are known as intangible assets. So you can't expense all of them when you pay them, like you could, training expense or labor expense or marketing expense. All of those expenses that I just mentioned are regular expenses. You can just expense them as incurred. But an initial franchise fee, you have to capitalize that as an asset, right? And you have to amortize it over 15 years. And so what that means in English is that you have to put it up on the balance sheet of your company. And to Chris's point, like this is stuff that, you don't have to know all this stuff. That's why you have, people like myself and my team to help navigate this stuff while you ramp up your business. You have to pretty much add it to the balance sheet of your entity, and you write it off over time, regardless of what the life of the territory is. For income tax purposes, your initial franchise fee has to be capitalized as an asset on the balance sheet as opposed to being expensed in full. And then it's written off, and then it's expensed through amortization over 15 years. And then if you were to sell the business, 8 years down the road, for example, then the unamortized amount of the franchise fee would add to your basis when determining your capital gain at sale. So that's what a franchise fee is. Royalty is, the percentage of revenue that you pay each month to the franchisor, as part of, it's what, it's the ongoing expense that you pay to the franchisor, as a franchisee, in exchange for using their systems, their trademarks, et cetera. Royalty is expensed as incurred. So a lot of times, I see on companies' books, like they'll post franchise, like they'll call royalties franchise fees, and vice versa, but they're two different things, and they're treated differently, as I just detailed, for accounting and tax purposes. So that's a big thing there. When I see, startup costs, franchise fees, marketing expenses, deduct some things you're already paying for. And so just a big thing to know there is, how franchise fees are treated from a write-off perspective compared to most other, expenditures, and with the difference between a franchise fee and royalty. Tax strategies for veterans. So take advantage of veteran-owned business credits, proactive tax planning for year-round benefits. So, depending on, being a certified veteran-owned business, could have its benefits depending on, like there are industry-specific things. For example, like if you're in a business that is going to be that you have the opportunity to land government contracts, whether they're federal, state, local, municipal, et cetera. Being a veteran-owned business, could be an advantage because the government is required to, award bids to, a quota of, certain amount of government of veteran-owned businesses, women-owned businesses, minority-owned businesses. That's one benefit of being a veteran-owned business. Another one is you can get some credits, some discounts on origination fees with SBA loans. And then also depending on where you are, there could be, state and local loans and grant programs that you're able to take advantage of because you're a veteran-owned business. And then proactive tax planning for year-round benefits. That is the way that my firm operates with our clients. So, when we're working in a paid context with our clients, we're not just filing taxes January through April, and then, we never reach out to you until next tax season, or unless you reach out to us with a question. We make sure that we have, multiple touch points throughout the year where we're talking strategy and implementing strategy, because that's where the magic happens. That's where the taxes are saved, trying to go to the holidays each year, knowing where you stand, as opposed to going into the next year and you're filing taxes and you don't know, are you going to get a refund? You have no idea where you stand. There are there are several tax strategies that you have to implement during the year. So you're never going to, you're going to always leave money on the table more often than not. If you have a relationship with your CPA where you're just talking during tax season and that's it. So effective tax management, maintain accurate financial records, collaborate with a CPA for optimal tax outcomes. So, collaborate with a CPA for optimal tax outcomes, rinse and repeat everything that I just said on the whole proactive tax planning for year-round benefits, and then maintain accurate financial records. So depending on what franchisor you work with, the franchisor that you work with will determine how you keep your books, right? There are some franchisors that require you to use their bookkeeping vendor, or like Horsepower Brands, for example. Like, I'm just using this as an example. Like, they have a wholly owned subsidiary called ZBooks. So if you go with the Horsepower Brands franchise, then you have to use ZBooks for your bookkeeping. And then there are other franchisors where it's like you're required to use a certain vendor for bookkeeping, or you have to work with the franchisor for bookkeeping for the first year, and then you can use, you can do your books yourself, or work with your CPA, et cetera. And then there are some franchisors that just allow you to, work with whoever you want to for bookkeeping from the jump. And so, whoever, my firm provides bookkeeping. There are multiple options, but regardless of who you use for bookkeeping, you want to make sure that you take bookkeeping seriously from day one, because the books for your company are the foundation of a streamlined tax return preparation process, a substantive tax planning conversation, and a substantive, CFO conversation talking about cash flow and profitability throughout the year. And then also, it also streamlines the whole process if you are trying to get a loan, either, like a residential mortgage or a business loan, or if you are, trying to sell your business and you have interested buyers. In all of those examples, it's a green flag when you have accurate, readily available, updated financial statements. And it's a red flag if you don't, and you're bumbling and stumbling to get basic information because your books are always behind and you're not taking your bookkeeping seriously. And so an accurate, updated, clean set of financials, and we're big fans of QuickBooks Online over at Reader CPA Group. QuickBooks Online, there are other platforms, but the common one out there is QuickBooks Online. So take it seriously from day one, because there are so many reasons that I just rattled off that are demonstrate why it's important to have an accurate, updated set of books, as opposed to, there's more reasons than just, because I need to get my taxes filed, so let me get my books updated. Like, having a clean, updated set of books is the foundation of so many things for your business. And so get in the habit of maintaining them from day one. And then avoiding common pitfalls, stay compliant with payroll and employment taxes. We're big fans of, having your payroll be done through a third party such as Gusto, ADP, or Paychex. Accept it as a cost of doing business. Focus your energies on other things. QuickBooks is, in my opinion, QuickBooks is great for bookkeeping. You can also do QuickBooks for payroll. It's just that there tends to be some manual stuff that you have to do with QuickBooks for payroll that are just much more streamlined to do with like Augusta or an ADP. So, using Augusta or an ADP, there are some PEOs out there like Resource Edge that you can use as well. But having some sort of third-party platform that just, automates and electronically files all of the payroll tax payments and quarterly and annual payroll tax filings, just, get with one of those payroll processing companies from day one is my humble opinion. And then understanding state and local sales tax obligations. Sales tax depends on what industry your business is in and what state you're in. So sales tax is a state by state thing. And that's, we have a great sales tax software, depending, because we have clientele across the country, depending on what industry you're in and what state you're in will determine what your sales tax obligations are. I think we're ready for the next slide, if there is one. Unit economics. Okay, cool. So I think the importance of P&L statements, tracking revenue, cost, and profitability. I just harped on that a lot with my whole spiel about the importance of having updated books, because by having updated books, then you can always just look at your P&L whenever and know where you stand. And again, there's a huge difference between, to be able to just press a few buttons and see where you stand from a profitability perspective, versus having to wait 2 weeks or 3 weeks because you're always behind doing a million things, and then you have to, and then your books keep falling on the back burner, and then you just never know where you stand currently, and it's always this big ordeal to know your numbers, right? So that's why I just take your book seriously from day one. If you don't have the time to do it, then hire out, right? Triple down on what you're good at and hire for your weaknesses. So it's if you're good at sales, then, go out and rainmake and hire, either, if your spouse has experience doing books, and have your spouse do the books, or hire a third-party vendor, have your CPA firm do it. But, that's just one, just if you don't have the time for the books, then hire someone else to do them and take it seriously from day one. Building projections, estimate startup costs and ongoing expenses, revenue projections, how much can you expect? So building projections, there's mainly two reasons to do it. First of all, it's always a good exercise for any new business owner to build your own projections. Think of it like, you're in school, right? And the project for the semester is to build your, approach it like a school project. It's a good exercise to go through as a new business owner, to know your numbers. Some of you might be really number savvy than others. And so if you're number savvy, you probably have fun doing it. And if you're not, it might be a tedious exercise, but it'll be worth it as an exercise to go through in preparation for business ownership, because, because your numbers are the lifeblood of your business. And so you need to understand your numbers, at least understand basic concepts, so you really learn a lot going through that exercise. So just doing it for your own education, right, as a new business owner. But then also a lot of times you'll need to do it as part of an SBA loan application. And the SBA, and so we're revenue projections, the primary source material where you're going to go for revenue projections is item 19 of the FDD. And, and so the SBA underwriter, when they're looking at your projections, they normally look for a 2-year projection. When they're looking at your projections, they're going to be comparing it to the item 19 of the FDD of the franchisor that you're going with, to see if are the revenue projections, are they consistent with what is in the item 19? So those are the main reasons for building projections. One, just for your own, education. And then also you're going to, you're going to have to do them if you're going through the SBA application process, and, relying on the item 19 as the primary place of source material for revenue projections. And then once you have revenue projections, then a lot of the stuff in the projections start to fall into place, right? There are certain expenses that are a percentage of revenue, like royalty and ad spend. And so those are plug and play. And then there are some things that you're going to have to do some research on, like what's the rental rental value per square foot in Phoenix, like versus New York, like those are going to be different numbers, or like the minimum wage, like the going cost of labor, et cetera, depending on where you are geographically speaking. There are some things that you're going to have to do some research on beyond just going off the FTD for revenue assumptions and then plug and playing some variable expenses. Then benchmarking, use FTD data to guide realistic expectations. I just touched on that. And then, compare with industry standards. Again, through good old fashioned internet research, you can come across platforms that can give you industry standards on like certain, profit margins and like how to value certain businesses depending on what industry that you're in. Oh, and break-even analysis. Calculate your break-even point, right? And understanding ramp-up periods in franchises. And so there's nothing fun about going through ramp-up, right? And so it's like you're going to start out, like, especially if you're going to. I'm talking about here. I mean, like I'll talk about here in the example of a new territory. Like if you're ramping up revenue from, like if you're investing it in a new territory, then you're going to start out with a loss. Like you're going to start out with more money going out than more money coming in, and that's completely normal. And so it's a brand new world. If you've never owned a business before, it's a brand new world. And so, but it's important to understand a few key. So first, cash flow is more important than profit because you need cash flow now and later, and profit you just need later. Like you need to have profit eventually, but you don't need it on day one, and it's impossible to have it on day one if you're starting with revenue, if you're ramping up revenue from zero. And so, when you're going through your projections and determining like what your revenue is going to be, what your expenses are, you'll get an idea of how long it's going to take you to ramp up from like start date to break even, and then from break even to certain profitability benchmarks. And so, if you're going to be an owner operator, are you going to be an owner operator? Are you going to work like 1 million hour weeks because you're not going to work your other job? Like you're resigning from your job, or you got laid off, or your spouse is like, working so he or she can hold on the fort with like, bringing in money for the household while you can ramp up the business. Like, so are you going to be an owner operator or no? And you're going to hire someone to, be a GM while you work your business. Right. So like those are two different situations. Obviously, if you are the owner operator, then you don't have to hire out to do certain things because you're going to do those things. So to be more of your time, but you're like, and again, there's always exceptions to the rule, but like that will most likely result in a quicker ramp up. And then if you're going to hire a GM because you're going to work your day job, then you're going to have to pay that GM. And so that's additional cost that you're going to have to overcome by scaling up a little bit more in order to, cover those additional expenses. So it'll take you a little longer to break even in that hypothetical because there's more expense because you're paying someone to do the thing instead of you doing the thing. But it's like, so depending on, are you going to be an owner operator or are you going to, hire a GM to run it? Like that will play a role in how long it takes to hit break even. And then also, so there's that. And there's something else I was going to say. And then just when it comes to making sure that you have enough capital, are you getting it from an SBA loan, ROBS, any other sources? That's another thing as well to take into consideration. There was something else I wanted to touch on that maybe it'll come back to me, but I forgot.
Okay, awesome. Thank you, Michael. Next slide, Rich. Yeah, listen, really great stuff. You can see that Michael can go deep and wide on this stuff, and you definitely want to have somebody like him in your camp. I just want to reiterate, guys, your core competency and your success as a business owner is not dependent on your knowledge of accounting or financing or any of that stuff. It's not. This is all stuff that needs to be set up, things like entity formation, the choice of which financing instrument that you want to use to fund your business at startup. Those are important decisions, but those are important decisions that you're going to make with the assistance of experts, including Michael and others that we're going to put you in touch with, and including your coach. those are also one-time decisions that are made up front. So it's important to get to know this stuff, but it's also important to let experts guide you on those one-time upfront decisions. Second thing, on projections, typically that franchisor, if you haven't seen that already, during unit economics, will give you a spreadsheet that's pre-populated with a bunch of formulas. It's important to go in there where to get the information. Michael mentioned the item 19. The other one is the item 7, where you can get some of the startup costs. And then you're going to continue to modify that and massage that throughout the whole due diligence process. You may talk with another franchise owner during validation who says, oh, that number there, it's going to need to be higher, or it's going to need to be lower for that expense. Or my projections on revenue first year were this. Yours are too low or too high. And so all of those things can be taken through a filter and adjusted. So those projections, I would argue, enable you as the business owner more than anything to understand how you generate revenue and how you incur cost. And at the end of the day, more revenues, less cost is what you're there to do. So don't overcomplicate it. Really just start to get a feel through the spreadsheet and through the numbers of how you generate more revenues, more top line, and how you minimize or maximize your bottom line through minimizing your costs. Finally, with bookkeeping. So when Michael talks about bookkeeping, some of you are very new. Some of you don't know the difference between a balance sheet and an income statement. That's okay. When we talk about bookkeeping, again, your franchisor is typically going to turn over a chart. It's called a chart of accounts, which are your typical transactions that you're going to have, right? So we have a sale. This is the revenue category that's going to hit. We incur an expense. This is how that's going to be recorded. Oftentimes, that chart of accounts is going to be given to you by that franchisor. Set it up in QuickBooks. It's pretty universal. It's pretty easy. You get it up. Sort of you set it and forget it. If you guys remember, Ronco food dehydrator infomercials back in the day, right? Set it and forget it. So it's one of those things that will require a little bit of upfront knowledge, but that's going to be largely given to you. And 95% of the transactions in bookkeeping are going to be routine stuff. If it's not routine, you've got people that you can call on to say, how do I record this expense or record this revenue? Okay. But again, important stuff. Thank you, Michael. Awesome. Next slide, if we would. Quick quiz, guys. If you would hit that QR code with your phone. I think there's just 3 or 4 questions here. So what are the ways that you can use the retirement funds to start your business? 401k or TSP loan, 401k or TSP withdrawal. So you can just withdraw that money. A ROBS, or all of the above? All right, we have got one, all of the above. We've got a ROBS for sure. ROBS is one of those. Is it all of those? It is all. Correct answer, it is all of the above. Next question. Which entity structure is required when using the ROBS or rollover as business startup funding strategy that forces you into a C Corp? That is correct. Excellent. Next slide. What are the primary ways of funding your business? Primary ways of funding your business. You can write a check in the form of cash. You can take it out of retirement funds. You can take it out of real estate, HELOC. You can get friends and family. And yes, that is all of the above. Excellent. Okay, next slide. I think this is the last question. What is the main difference between a franchise fee and a royalty? So both are monthly payments. Franchise fee is a one-time payment. Royalty payment is ongoing, or the opposite of that, or there is no difference. And yes, correct. Franchise fee is that one-time payment up front, which, by the way, you will pay when you sign your franchise agreement, which is usually within a week after discovery day or confirmation day. And that royalty payment is ongoing. Now, I will say, oftentimes there will be a period of startup where the royalty payments will either be waived or minimized. Some franchisor are okay with that. So that'll be in your FDD. Okay, excellent. Next slide. Good job, guys. Finally, we'll take some Q&A here as a group. Michael is also going to be joining the subgroups. We ran a little bit over this morning. My apologies but if you have an extra 5 or 10 minutes, please go into the subgroups with your coaches, the breakout sessions with them, and then Michael will be joining each of those. Okay. Rich, if you would go ahead and put us into those subgroups. Appreciate it. Thanks, everybody. Great to see everyone, and we'll see you next week.